Greetings, everyone. Welcome to Thursday's Liberty Call for September 22nd, 2022. Hope everybody's having a great day. My beard is trying to be unruly on camera, even after I brushed it. Anyways, if it's your first time here, please slam all those subscribe, like, alerts, all that good stuff. Give me some thumbs up. I like those. And thank you for joining me. Not a great day in the markets. Lots of red across my screen. Looks like it's kind of a contagion that's gone across the world right now. I guess traders did not take the news of a Fed rate increase again, which anyone who's caught off guard by this is, not paying attention. So, anyways, let's go ahead and jump into the numbers, see how things are or were today. The Dow Jones was down 0.35% or 107 points. Closed at 30,076. S&P 500 down 0.89. Closed at 3756. NASDAQ down 1.37%. Looks like technology took the worst of it today. NASDAQ closed at 11,066 for the day. Small caps are down 2.5%. The VIX fell 2.61%. It's currently sitting at 2726 as of right now. Canada was down 0.95. Brazil up 2.02%. So that was kind of an outlier today. Mexico down 1.42. Jumping over to Europe, Germany down 1.84. UK down 1.08. France down 1.87%. Euro stocks down 1.85. Netherlands down 1.85 also. Spain down 1.24. Italy down 1.07. Switzerland down 1.26. And Portugal down 1.82. Both Russian exchanges, opposite of yesterday, in the green today by quite a bit. The MOEX was up 2.82, the RTSI up 6.12%. Wow, pretty big jump for them. Headed over to the Asian markets, Japan down 0.58, Australia down 1.56, New Zealand up 0.34. In China, the Shanghai was down 0.27, the SESE component down 0.84, the China A50 also down 0.84, DJ Shanghai down 0.38, and the Hang Seng came down 1.61%. Taiwan weighted was also down 0.97% for the day. So, like I said, a lot of red, a couple greens here and there, some outliers, but for the most part, it was a red day in the markets. So, but hey, like I learned from one of my mentors back years ago, money is made when there's blood in the streets. And, unfortunately, there's probably going to be a lot of blood here and a lot of carnage here in the near future. So do not be surprised. All right, well, let's jump into today's market recap. Wall Street drops as mounting growth concerns weigh on tech and financials. Wall Street's main indexes were on course to post their third straight day of declines on Thursday as traders sold financial and technology stocks on fears that the Federal Reserve's aggressive approach to rein in inflation could trigger a recession. Shocking, I know. This completely catches me off guard. I was completely unaware that we could be heading into a recession. I only have been saying this for close to a year at this point. Jumping back in, the U.S. Central Bank's projections for economic growth released on Wednesday were also eye-catching, with growth of just 0.2% for the year. So they've had to revise those down, rising to 1.2% in 2023. So this is something that someone pointed out. I think it was Ben Shapiro in his podcast this morning mentioned that, Chairman Powell just came out and basically is being very blunt. Hey, things are ugly right now. Things look terrible and they're not going to get a lot better. So, if he's finally being honest with the people. So it's a little surprising from my point of view. Quote, going forward, the market is going to be hypersensitive to any sort of Fed comments and data coming up. I would expect more volatility as the market digests them, but at the same time, we're cautiously optimistic, said Brian Klimke, Director of Investment Research at DSA Financial Group. Quote, valuations are a lot better than they were at the start of the year. Earnings estimates have been lowered. That makes it a lot easier to beat. So a lot of the bad news is factored in right now. We're just creating a market where there are potential upside surprises now, end quote. The S&P 500's forward price to earnings ratio, a common metric for valuing stocks, is 16.8 times earnings, far below the 22 times forward PE that stocks commanded earlier in the year. So obviously prices have come down. I personally like price to earnings ratios lower than 15. But that's just me. That's, if I'm going to pick out individual stocks, I want low PE ratios, and if they pay a dividend, even better. All right. 7 of the 11 major S&P sectors declined, led by a drop of 1.9% in consumer discretionary and 1.3% in financial stocks. Shares of mega cap technology and growth companies such as Apple, Amazon, Tesla, NVIDIA fell between 0.7 and 4.9% as benchmark U.S. Treasury yields hit an 11-year high. Rising yields weigh particularly on valuations of companies in the technology sector, which have high expected future earnings and form a significant part of the market cap weighted indexes such as the S&P 500. And I know we talked about this before, but typically as interest rates rise, that hurts the valuation of like your technology. Companies that on paper look like they're valuable, but necessarily may not be worth a pile of poo in the end. But when interest rates are really, really low, it makes those future valuations look so much better and makes them a lot more attractive to equity buyers. So that's why you've seen a lot of stomping and hand wringing from the financial journalists over the last year about, oh, well, when are we going to start lowering rates again? It was like, well, we haven't even started raising them. So that was the conversation last fall and early winter. And then as soon as they were raising rates, it's like, well, when are they going to start lowering them? It's like, well, we haven't solved the problem that why they're raising the rates in the first place. I mean, inflation is kind of the bigger issue right now. And the money printing, which was the catalyst for a lot of this. But there's been a lot of bad behavior over the last 20 years between the government and the Federal Reserve. So there's a lot of finger pointing to go around. All right, where were we? Quote, I definitely see the market testing. Jumped too far. The S&P 500 tech sector has slumped 27.8% so far this year, compared with 20.9% decline in the benchmark index. And that actually brings to mind that the NASDAQ is currently down over 30% so far year to date, and the S&P 500 is back below 20% at this point. So both of those are in bear market territory. The Dow is in the teens right now as far as peak to trough or peak to bottom right now. So things aren't good. Again, a lot of these journalists can sugarcoat it, try to make it look better, but it's not great. Let's see here. Quote, I definitely see the market testing June lows, and there's an increasing likelihood that the new lows will be set as indicated by the rise in the 2-year yield and the widening of the inversion of the 2-year and 10-year yield curve, in quotes, it's Sam Stovall, chief investment strategist at CFRA Research. Sam is very smart, and he's someone that I've listened to through the years. And if he talks, I'd listen to what he has to say. See here. The S&P 500 is now 3% away from its mid-June low, its weakest point in a year. So not good news there. So again, buckle up, position your portfolios for probably some rockiness and some volatility coming up. Because if I were to look at probabilities, do we have a greater probability of the market continuing to go down, or the market to turn tail and head northeast and have positive returns moving forward from right now? I don't know. You don't have to be a bet maker or an odds maker in Vegas to look at the bigger picture and say, well, here's what I think is really going to happen. So if you need some help, look me up. I'd be happy to help you out. All right. Next up is labor data. U.S. labor market resilient as recession signals grow stronger. The number of Americans filing new claims for unemployment benefits increased moderately last week, indicating the labor market remains tight despite the Federal Reserve's attempt to cool demand with aggressive interest rate increases. The weekly unemployment claims from the Labor Department on Thursday, the most timely data on the economy's health, suggested that job growth remained solid this month. The U.S. Central Bank delivered a 75 basis point rate hike on Wednesday, its third increase of that magnitude. It signaled more large increases to come this year. Quote, Fed's officials are hitting the brakes hard, but so far employers are just giving this policy a great big yawn, holding on tight to their workers, in quote, said Christopher Rupke, chief economist at Forward Bonds. Quote, it's either that or there's some sort of stealth job losses were those made redundant are not getting unemployment benefits, end quote. So yeah, I've heard a lot of people talk about that. Where are all the people? It's like these jobs are empty, but it's like, where are the human beings that you're either collecting unemployment benefits or sitting on the street, because we just don't see them right now. Initial claims for state unemployment benefits rose 5,000 to a seasonally adjusted 213,000 for the week ending September 17th, the Labor Department said Thursday. Data for the prior week was revised to show 5,000 fewer applicants filed than previously reported. Economists polled by Reuters had forecast 218,000 applications for the latest week. Fed Chair Jerome Powell told reporters on Wednesday that, quote, there's only modest evidence that the labor market is cooling off, end quote, describing it as continuing, quote, to be out of balance, end quote. Since March, the Fed has raised its policy rate by 3 percentage points to a current range of 3 to 3.25%. Unadjusted claims rose 19,385 to a still low 171,562 last week. There was a surge in applications in Michigan and notable increases in California, Georgia, Massachusetts, and New York. Only Indiana reported a significant decrease in filings. Economists say companies are hoarding workers after experiencing difficulties hiring in the past year as the COVID-19 pandemic forced some people out of the workforce, in part because of prolonged illness caused by virus. I would venture to say probably more people were out of work because they refused to get the jab. But that's just my own point of view. But I wonder if they're hiring those people back yet, since the treatment didn't exactly work out as promised from a year ago. So anyways, we'll see. Economists say companies, I read that part. There were 11.2 million job openings at the end of July, with 2 jobs for every unemployed person. So the jobs are out there, folks. If you don't like what you do, maybe get trained in some skills, or provide, or maybe start a business and provide a service for something, clean out septic tanks or what. I mean, there's always a need, or there are always things that people want other people to do for them. So it's not like, you just have to find that need, whether or not it's created in cell phones or, I mean, who knew? I was talking about this with my older boy the other day that, prior to the smartphone, I never realized I had a need to have a computer in my pocket. It was nice to be able to make phone calls on the run and to, get my email and texts and things like that, instantaneously. But being able to play Angry Birds, who knew? I didn't. All right, last article I got here has to do with mortgages. Mortgage rates jump again and remain above 6%. Well, that's a consequence of raising interest rates. So mortgage rates jumped more than a quarter point this week and remain at the highest level in 14 years, offering no relief to sidelined home buyers. The average rate on a 30-year fixed mortgage increased to 6.29% from 6.02% last week, according to Freddie Mac, marking the highest point since the last week of October 2008. Rates are more than 3 percentage points higher than at the start of the year. Rapidly rising rates this year have only made what was an uncomfortable housing market for many even worse, forcing those would-be buyers to pause their purchasing plans. Those who remain, though, are finding it easier to negotiate with sellers than when the year began. Well, obviously, if you got less buyers, sellers are going to have to be a little bit more willing to negotiate on price. Quote, for buyers watching their take-home pay shrink due to high prices and shopping budgets diminish due to rising rates, today's housing market remains highly unaffordable, end quote, George Ratui, Realtor.com's manager of economic research, said in an email to the press. Quote, in many locations, price cuts may be the only viable option to restore housing balance and affordability. I think I've been saying that for a while. The jump in the 30-year rate came as the Federal Reserve reiterated its steadfast commitment to rein in runaway prices on Wednesday after it increased its short-term benchmark rate by 0.75 of a point as expected. The yield on the 10-year Treasury, which fixed mortgage rates tend to track, jumped to the highest level since 2011 on those inflation-fighting expectations. Mortgage rates soon followed. The Fed also started to reduce the amount of mortgage-backed securities it holds on its balance sheet this month, according to Ratui. Quote, these actions will cause mortgage rates to continue to rise until inflation shows signs of more significant moderation, Ratui wrote. Since mortgage rates started their rapid ascent in earnest in March, buyers have been flowing out the exits. The volume of mortgage applications for purchases is down 30% year over year, according to the latest data from Mortgage Bankers Association, even though the activity registered a small seasonally adjusted 1% uptick week over week. Sales of previously owned homes also declined for the 7th straight month in August, according to the National Association of Realtors, bringing down the median listing price for the second consecutive month. Price stood at $389,500 in August, down $24,000 from a record high of $413,800 in June, but still 7% higher than a year ago. The monthly payment of a median priced home at a 30-year rate is about $900 higher than a year ago, according to Realtor.com, or nearly $11,000 more per year. Let's see here. Quote, 60% of my clients who were pre-approved a few months back, they want to wait to buy a home. In quote, said Scott Sheldon, California branch manager of New American Funding, a mortgage lender, told Yahoo Money. Quote, those are all the folks who are buying with 10% or less down. So I can't blame them. End quote. Sellers have noticed the abrupt change in the market standing. Approximately 11% of homes for sale had a price cut last month. Realtor.com data showed up 19.4% year over year, and close to averages from 2017 to 2019. Fewer homes sold above list price in August, according to a separate study by Redfin, with 35% going above asking, down from 49% a year ago. Home builders, too, have been offering concessions as the buyer pool shrinks. Nearly 25% of builders reported reducing their price this month, up from 19% in August, according to a monthly survey and index from the National Association of Home Builders, while half said they offered mortgage rate buydowns and free amenities, among other inducements to close the sales. That's some relief to buyers still in the markets, Sheldon said, who are using their newfound negotiating power to get price reductions that offset the recent rise in rates. Quote, buyers who can handle the storm temporary higher rates are going to do really well on their house. Even every purchase we're doing has a price reduction or price incentive, end quote, Sheldon said. But it's still a challenge, he added. Quote, everyone is paying points, so closing costs are not 2 to 2.5% of the purchase price anymore. They're 3 to 3.5%. That's additional money they need to bring to the table to get the rate they want, end quote. So, yeah, this is something that I've said multiple times over the last years that, with housing getting out of control, once interest rates did start climbing, it was going to push a lot of the, buyers at the bottom of the buying curve out. Or if you were trying to get house A, you might have to go with house B just because of an affordability issue. It's something I've been through in my own life, where I wanted to live in Houston back in 2007, I had to buy an older home, in the area that I wanted, and, actually turned out to be a really great deal. But, sometimes you got to change your expectations. You're not going to get everything perfect in life. And unfortunately, that's just the way life is. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And if you need to book a meeting, drop me a phone call or shoot me an email. All that's there. You can read through all the amazingly entertaining stuff that I have on there. And hope everyone has a good night. I'll be back tomorrow with Thursday's Liberty. I'm sorry. Today is Thursday. We'll be back tomorrow with Friday's weekly wrap up. And I hope everyone has a good night. Adios.